Hi there, tax accountants, non-accountants, taxpayers, and tax professionals. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. In this video, we're going to cover the One Big Beautiful Bill Act. Let me start with a confession. Because if you only learn about taxes from headlines, a lot of times people, they might think that Congress, they just flip a bill every December and they call it tax law. But the truth is the tax code, it's not random, it's intentional. And the One Big Beautiful Bill Act, it's a perfect example of that. This video, we're going to pull back the curtain, not just on what changed, but why it changed, who it helps, who it doesn't, and how to stop leaving money on the table just because no one explained the rules clearly. So why do taxes exist? Taxes don't just exist to pay bills. Obviously, yes, taxation is one of the ways in which the government generates revenue. But if that were the goal, then the tax code, it'll probably be about 10 pages long. But instead, the One Big Beautiful Bill Act, they estimate that it's about 1,116 pages long. Who's going to be reading all of that? Ain't nobody got time for that. So with that being said, it's 1,000 pages in Congress. They use taxes ultimately like a steering wheel. Economic policy, wealth distribution. So if you want more people working, what do? They'll adjust the wage rules. If they want more domestic manufacturing, what do? They adjust deduction for businesses. And if they want behavior without mandates, they use incentives similar to charitable contributions and things of that nature. 529 plans whereby families can save for college and they receive an incentive when they file their tax return depending on which state they live in. So the One Big Beautiful Act is full of these different steering decisions. So before we jump into any of the changes, it's very important to understand, how do federal income taxes actually work, right? For some people, when you talk about taxation, it feels as though you are speaking another language. So if you don't understand the structure, every tax change sounds bigger, smaller than it actually is. So all income comes in first, every dollar. So ultimately, what that means is that the federal government states that all income from whatever source derived is considered income unless there's a specific exclusion within the Internal Revenue Code, right? So I am a US citizen. I have family from Guyana. In the event that I start a business venture in Guyana, just because it's outside of the United States, Uncle Sam says, well, it states all income from whatever sources derived. So with that being said, all income that I earn from outside of the US, that is considered income again. So it's always best to make a presumption that all income is taxable, again, unless there's a specific exception. With that being said, then we have deductions. We have the standard or the itemized deductions, which we'll discuss in detail a little later, that reduces your taxable income. And from there, that's where you apply the tax rate. So we have what's called progressive tax rates. So a lot of times people think that they're just taxed at one single tax rate. That's not ultimately how it works. Think of it like buckets, and each amount of income that falls within a specific bucket, then it'll be taxed at one of more of those 7 tax brackets. And then after that, that's where credits are applied. And credits offer a dollar for dollar reduction, and that determines whether you have a final tax owed or whether or not you will be subjected to a refund. So most tax myths, they exist because people, they confuse these steps, especially when it comes to deductions versus credits. So deductions, that ultimately reduces your taxable income, versus credits, whereby it's a dollar for dollar reduction in your tax liability. So taxes, they're layered, right? As we see, we start off with our income. From there, we go to our deductions. From there, we have our tax calculation, our credits. And from there, we have that final determination whether or not you are going to be receiving a refund or whether or not you owe Uncle Sam. States, they do things a little differently. However, the structure for the most part is typically the same. So understanding this sequence, it is very essential to understand how any tax changes are ultimately going to affect your liability. So if you mix up the layers, you're going to misunderstand the rule every single time. So with the One Big Beautiful Big Act, this is the most important sentence we're here today. So the standard deduction, this is basically the floor of the entire system. So simply stated, when you think of the standard deduction, think of this as an amount of money that Uncle Sam allows you to keep tax free. Simply stated, and it is based on your filing status. There are 5 filing statuses. You're either single, married filing joint, married filing separate, head of household, or qualifying widower. So in addition to your filing status, it's also based on your age. So again, standard deduction, just think of it as an amount of money that Uncle Sam lets you keep tax free before they actually start to tax you. So roughly 9 out of 10 taxpayers, they never itemize. So we have standard deduction and then we have itemized deduction. So itemized deductions, this is a list of personal expenditures that Uncle Sam allows you to deduct. Many of them are subjected to limitations. So we have medical expenses. You can typically only deduct medical expenses if it exceeds 7.5% of your adjusted gross income. We'll talk about the state and local taxes. There was a very big change. You'll see that in a few slides. But again, most people, they never itemize, especially with the removal of personal exemptions and the increase of the standard deduction. So just key thing to keep in mind, standard deduction, an amount of money Uncle Sam lets you keep tax free. So for 2024, the standard deduction rates were as followed. If you were single or married filing separately, the rate was $14,600. If you were married filing jointly or qualifying surviving spouse, which is often also referred to as qualifying widower, that standard deduction was $29,200. And if you were head of household, that standard deduction amount was $21,900. So let's say, for instance, if someone is single or married filing separate and they only made $14,000, based on their situation, they might not have to file. In a situation whereby taxes were withheld, then they would need to file a tax return because that's the only way to get a refund. But ultimately, if that person earned $14,000 in income and there were no taxes withheld, ultimately they do not have a tax obligation. Why? They earned $14,000. Uncle Sam, because of their filing status, lets them keep $14,600 tax free. So therefore, there's no filing requirement. But of course, taxes are never just fully straightforward. There is a bit of nuance. So again, we just want to discuss the standard deduction so we can anchor ourselves. So this is the baseline standard deduction before a single tax bracket even kicks in. So now we move on to 2025. So this is where the One Big Beautiful Bill Act quietly does a lot of work behind the scenes. So in 2025, the standard deduction jumps. And why? You might ask yourself, inflation. If you go to the grocery store, today I went to buy, a certain type of milk, and the milk was about $10, even eggs, upwards of $9. And I was like, wow, this is very interesting. I did not get the eggs. I did get the milk, however. So with that being said, because of inflation, every year there's an increase to the standard deduction. So in 2025, the standard deduction amounts for single, married filing separate, $15,750, married filing joint, in qualifying surviving spouse, it jumps to $31,500. Head of household, it jumps to $23,625. So when it comes to the standard deduction, there's no application that needs to be filed, no election, no paperwork. It's just less income that's being exposed to taxes in light of inflation. So as it relates to 2026, this isn't just a one-year bump. In 2026, the deduction is going to increase again in alignment with inflation, right? So this basically tells us something important. Congress wants this part of the Internal Revenue Code for it to be like a relief ultimately. So what this ultimately means in real life. So here's what people miss sometimes. If you're a single filer, one of the key things you should do is you should shield over $1,000 more in income from 2025 than in 2024 automatically. And what that ultimately does is it compounds over time. So that's why understanding the baseline, the standard deduction, it matters more than just chasing certain deductions. So as we can see here, from 2025, in comparison to 2024, for 2024, the rate for the standard deduction was 14,600, and in 2025, 15,750. So with that being said, there's a difference of about $1,150 more in income that's being shielded from taxes. There's also a new senior additional deduction. So there's been a lot of discussion in regard to the taxation as it relates to Social Security benefits. And I believe that this was in response to that. So ultimately, there's a new benefit for these taxpayers if they are above the age of 65. So this is one of the most overlooked provisions in this new change. So if you're 65 or older, you'll get an additional $6,000 deduction per person from 2025 through 2028. So if both taxpayer and spouse are over 65 years old, that's $12,000. That's in addition to the regular standard deduction that is not going to be taxable. So, translation, Congress, they're quietly shifting a huge amount of taxable income off the table for retirees. And as mentioned, I believe that this is in response ultimately to there being a lot of uproar, a lot of questions in regards to the taxability of Social Security benefits. But one of the key things is that this is a temporary provision. And we know what the word temporary means. It's not permanent. So this is only effective for tax years 2025 through 2028, unless, of course, this becomes permanent law. But I guess we just have to wait until 2028 to see what happens. So we look at the senior deduction in a real world impact. So let's say we have a married couple. Both of them are 67. The 2024 deduction was 29,200, but if we compare it to 2025, the standard deduction was $31,500. So with that being said, in 2025, as compared to 2024, their total deduction would be $43,500 as compared to only $29,200. All right. So as we see, this is a structural shift, especially for people that are living on a fixed income, because typically people above the age of 65, they are living based on pension income, Social Security. So with this greater additional standard deduction, seniors, they ultimately do not run the risk of reaching those thresholds. So now we move on to tips and deductions. So this is one of the areas of the One Big Beautiful Bill Act that's been very misunderstood and misinterpreted. So one key thing to keep in mind, tips, they are not tax-free. They are deductible. All right. So there's a very big difference between the two. So up to $25,000. But the key thing is if they are reported. So ultimately, if it's not reported, you don't get the benefit. So this deduction, it phases out at higher incomes and it does expire after 2028. So that is something to keep in mind. So the maximum is 25,000. Much like the senior additional deduction, this is a temporary provision, and the phase out begins at $150,000 if you're single and $300,000 if you're married filing joint. Key thing, the tips need to be properly reported to the employer as well as to the IRS. And as we know, a lot of times, especially when you're in businesses where you're dealing with cash, it's very hard to track cash, right? If you're getting payments through a card and things of that nature, the third party merchant, they'll send you a statement because obviously they're processing the payment. Cash, on the other hand, who can really track it, right? Uncle Sam doesn't necessarily have the manpower to track down every dollar. So I believe that this provision is kind of like twofold. It encourages people to ultimately accurately report what they're receiving. Of course, there'll probably still be, people who don't report everything. But I believe that, like I said, this is twofold. More people are going to be likely to want to report tips so that way they can take the deduction. But another issue, that I've heard is that now some businesses, what they would try to do is to allocate more of the income received and claim it as tips, quote unquote, to take advantage of the deduction. So I'm pretty sure that there's going to be a rollout of new rules and nuances regarding how this is going to play out. So I guess we just need to wait to see. So this wasn't written to help people hide income. As mentioned, I believe it was written to reward transparency. So we shall see how this works out. Next, we move on to overtime deduction. Overtime is going to work the same way, but only the premium portion is going to qualify. So that means the extra half in the time and a half. So this deduction is going to cap at $12,500 for single filers, and it's going to be capped at $25,000 for joint filers. So again, this is temporary. And again, the income is going to be limited. So Congress, they're very clearly saying we want people working, but we want it documented. So again, this is another area within the tax code that has been misunderstood and misinterpreted. And I trust that there are going to be more regulations that are put out so that way tax professionals and taxpayers, they have a better understanding of how to accurately account for tips as well as overtime. So now we'll just take the time to look at some myths versus some realities. Again, as mentioned, the tips and the overtime, they are not tax free. So that's the myth that's going to get a lot of people in trouble. Tax-free wages. This phrase does not exist in the tax law. So tips and overtime, these are considered deductions. They are not exemptions. So a $25,000 deduction does not say $25,000 in tax. And that misunderstanding, that difference, it is expensive because God forbid should Uncle Sam find out, right? So that's one of the things that people don't realize when it comes to things that are not reported accurately on your tax return. If it's below 25% omission, then they have 3 years to come after you. If it's more than 25% omission or error, then they have 6 years to come after you. If it's fraud, they can come after you forever, forever, ever, ever, ever. Okay. So that is something that people do not realize. They'll, see a year pass, 2 years pass, and they're like, hey, I got away with it. I didn't get a letter from Uncle Sam. Okay, give it some time. If you eventually get that letter in the mail and it is fraud, you cannot defend the 3 or the 6 year statute of limitation. Very important. So now we move on to one of the next changes within the One Big Beautiful Bill Act. For families, the child tax credit increases from $2,000 to $2,200 per child. So it might not seem like a lot, but credits, as we know, in comparison to deductions, they reduce your tax liability dollar for dollar. So this is targeted relief that helps, parents, families ultimately. Next, we move on to a very, very big change, one that I personally was bothered by. So we have what's called the state and local tax deduction. So with the Tax Cuts and Jobs Act, there was a change ultimately whereby state and local taxes were capped at $10,000. So this included taxes that were paid to your state government. This included property taxes. This included sales tax. So it was capped at $10,000. So for people that live in states like California, New Jersey, New York, like myself, and I don't just live in New York State, I also live in New York City, which means that I am subjected to state taxes as well as city taxes. What a pity. All right. So, with that being said, considering sometimes within a year, you can pay upwards of $20,000 for taxes, property taxes, another $5,000. So, can you imagine? In total, your state and local taxes are about $20,000. And people that live in these states and they have high income, it could literally be upward of $50,000, even more. And they are capped at $10,000. So thankfully, with this new change, it increases to $40,000. I'm actually excited to file my tax return this year, right? And I see how this is implemented. So $40,000 for tax years 2025 to 2029. Again, it's a temporary increase with income-based phase down. So that's kind of one of the challenges. But again, this is only relevant if you claim itemized deductions. Most taxpayers are still going to benefit from the standard deduction. Itemized deductions that typically applies when you have medical expenses, you pay property taxes, mortgage interest, charitable contributions, and things of that nature. I personally will benefit, so I am very happy about this change. So, who benefits from the higher salt cap? This is just to reiterate what I just mentioned. So, high state taxes, California, New York, New Jersey, Illinois, those with significant state and local tax bills, high income itemizers, those again with a mortgage interest, you own a home, personal property. If you have a rental property, that will be deducted on Schedule E as an egg. But when you have a personal home, itemized deductions are reported on Schedule A as an apple. So mortgage interest, charitable giving, state taxes that exceed the standard deduction, and again, property owners, those that have substantial property tax assessments. So we move on to another change, car loan interest deduction. So starting in 2025, interest on qualifying car loans, they become deductible up to $10,000 per year. But there are some nuances. It's only for new loans. It's only for qualifying vehicles. The VIN number is going to be required, and there are some income limitations. So this is just pretty much industrial policy using the tax code, because now people will be like, hey, why not get a car because I can get a deduction for it, right? So obviously, that's again one of the benefits of tax law. It kind of helps to encourage certain behaviors. The tax law is not just about generating revenue, it's also about social policy, economic policy, and things of that nature. So, as it relates to this car loan interest, as mentioned, definitely important to plan before you actually make this decision, because it would be such a pity to go out and just purchase a car and it doesn't even apply, right? So, what qualifies? Interest on loans for personal vehicles, new or used car purchases, and this for refinance loans. If the original loan was after December 31st, 2024, what does not qualify? Very important. So, lease payments. If you lease a car, doesn't qualify. Principal payments do not qualify. If you purchase your car December 30th, 2024, unfortunately, it does not apply. Business vehicle loans, they have different rules that apply. So very, very important. A lot of times I see clients, they make decisions and then they come to their tax professional after the fact. So that's what's called a closed transaction. The transaction already happened. There's only but so much that can be done versus an open transaction. Hey, CPA, enrolled agent, tax professional, preparer. I'm thinking about getting a car. I'm thinking about leasing a car based on the tax rules. What should I do? Right? That's an open transaction. Now, because the transaction has not yet happened, we can better advise. So, if you are planning on purchasing a vehicle, you definitely want to make sure that you take the time to reach out to your tax professional first or do some research yourself. All right. So, temporary provisions, they have clocks, as we know. So almost every new benefit that we've talked about thus far is going to come with an expiration date. So planning without looking at it is like you're just setting yourself up for failure pretty much. So in 2025, most one big beautiful bill, or OBBBA as we call it, most OBBBA provisions are going to take effect starting 2025 tax filing season. 2026, the standard deduction increase is going to continue. In 2027, the workers deduction is still going to be active. 2028, this is the last year, of course, unless they make a decision to extend or make it permanent. But 2028 will be the last year for senior additional deduction, tips, and overtime deductions. And in 2029, the SALT cap is going to expire, the increase. Well, hopefully, I'm hoping again. I'm from New York, so I am hoping that they do not revert to $10,000. But I guess we just got to see what happens. So, with these permanent versus temporary provisions, this is just again a little overview of everything. The permanent changes, the standard deduction, again, that increases every year. It's indexed for inflation. Child tax credit is going to be increased, and the core tax bracket structure that stays the same, right? So, one key thing to keep in mind is that the tax rate structures, ultimately one of the benefits is that we have seven tax bracket, and ultimately they were reduced after the Tax Cuts and Jobs Act, or in light rather of the Tax Cuts and Jobs Act. So right now, the seven tax brackets for 2025 is 10%, 12%, 22, 24, 32, 35, and 37%. Sorry about that, right? So that's definitely one of the benefits. So with that progressive tax system, as mentioned earlier, that simply means you pay higher tax rates on higher portions of your income, right? So for example, let's say somebody's a single filer, they have $60,000 in income. They're not paying $22,000 on the entire amount. First, a specific portion will be taxed at 10%, then another portion taxed at 12%, and another portion taxed at 22%, right? So that's one of the benefits with the core tax bracket structure. It stays the same. But prior to the Tax Cuts and Jobs Act changes, the percentages of the tax rates were much higher. And again, temporary, as we mentioned, the senior additional deduction, tips deduction, overtime deduction, and the SALT cap increase from 10,000 rather to 40,000. So again, Congress, they may extend it, they may not, we don't know. But as a taxpayer, you should never assume the extension when you're planning, because you definitely don't want to get hit with a very large tax bill. All right, so now we move on to some things that apply to side hustles, those that are entrepreneurs, self-employed business owners. So we have this 1099K reporting threshold. So the 1099K threshold, it goes back to $20,000 into 200 transactions. So one key thing to keep in mind is that this 1099K, ultimately, it does not create tax, but what it does do is create visibility. So with the 1099K, this is basically an official IRS information return. And this is used to report any payments that you receive from payment cards. So if you use credit cards, debit cards, gift cards, any third-party payment networks like, let's say, Venmo, or eBay or PayPal, any of these third-party processors when you are selling goods and services. So this form, it basically helps the business owner, the individual, as well as the IRS, track all of the business income. So let's say you get this 1099K and it shows $30,000 and your business tax return only shows $15,000. Uncle Sam might say, okay, this person is probably hiding money, right? So with that being said, this is just a way in which to create visibility. Income is always going to be taxable. This form ultimately is just shining a flashlight on it. So mentioned with that example, someone reporting only 15,000 and the form shows 30,000. Uncle Sam is saying, where's the money ultimately? All right. So who wins? Here with this 1099K, again, doesn't create tax liability. If you get the 1099K, you're not going to owe taxes on that full amount, because obviously you're running a business. In order to make money, what do you need to do? Spend money, right? So of that $30,000, from there, you can record and account for all of the expenses that it took for you to be able to generate that $39,000. So again, 1099K is just an information report. You owe tax on the net profit, not the gross receipts. So deduct your business expenses, all of the ordinary, necessary, and reasonable business expenses. So who's going to win under this tax law, under OBBBA? So it's going to affect different taxpayers differently. So for young professional, they'll benefit from the higher standard deduction, overtime deduction, if it's applicable, as well as tips. Families, the child tax increase and the potential tips deduction for service workers. Seniors, they'll definitely benefit, especially those that are married, for $6,000 to $12,000 of an additional deduction through 2028. And then for side hustlers, entrepreneurs, self-employed individuals, business owners, the 1099 reporting awareness, business expense deduction is going to be critical. So that is why, as a tax professional, you want to urge your clients to make sure that they're not missing any deductions. It is imperative to ensure that they have proper business records. So just some key takeaways, right? So this isn't an exhaustive overview of the One Big Beautiful Bill Act. fact, but obviously some of the key things were covered in this video. So if you were preparing a tax return for 2024 for a client that's filing late, in comparison to 2025, you'll see that there are some key differences. So that was ultimately the purpose of this video. So one of the key things, as their strategic tax planning, this is an opportunity for you to plan ahead. One thing I always tell my clients is that you want to be proactive, not reactive. So with that being said, understanding your baseline, calculating or assessing your 2024 tax liability in order to establish a point of comparison. From there, you want to identify any applicable provisions. So, which new deductions, which credits are going to apply to your specific situation. From there, you want to model any 2025 scenarios. And from there, you can project, well, hey, based on the new rules, and the income levels, this is ultimately potentially what my tax liability will be. And then from there, you want to plan for the changes. So prepare for 2029 when some of those temporary provisions expire. Especially, I would be considering my clients that are retirees, right? In their situation, what if they don't decide to account for that additional senior deduction? And in such case, I would let them know, hey, the little few $100s that you're saving in taxes, save that up just in case after 2028 this does not become a permanent part of the Internal Revenue Code or they don't extend it. And then lastly, document everything. So maintain records for tips, overtime, car loans, business expenses, etc. Documentation is key because in the event, God forbid, Uncle Sam comes knocking, you need to make sure that you have everything in place. And then these are just some common planning mistakes to avoid. Assuming that tax-free means no tax. Again, that is not the case. So deductions, they reduce taxable income. They do not eliminate tax entirely. Credits, on the other hand, credits are a dollar for dollar reduction of your tax liability. Lastly, ignoring phase outs. Many provisions, they reduce or disappear at higher income levels. So many of the deductions that we mentioned, once you start making over 100,000 or 150,000, these deductions, they sound great. But because you're in a high income bracket, according to, Uncle Sam, unfortunately, you don't qualify. So you definitely need to consider these things. Also, forgetting documentation. Again, IRS, they require substantiation for all deductions claimed. There's nothing worse than getting a notice from Uncle Sam and you cannot substantiate what was reported in the tax return. And again, not planning for those sunsets. These things might not be extended. Maybe they might become permanent. Maybe they might be extended. We don't know. Temporary provisions expire, so you do not want to build long-term plans around them. All right, and these are just some professional considerations for tax preparers. So those of you that are tax accountants preparing to get into the industry, those that are tax professionals, and even taxpayers, these are things that you want to make sure. Hey, is my tax preparer, is my tax professional doing this? Client communication. You want to explain the difference between deductions and credits clearly. Again, for some people, taxation, it just feels like a foreign language. So you want to be able to break things down in layman terms and set realistic expectations about tax savings because Lord knows there's so many clients that reach out to me with things that they see on social media and I watch the video and I'm like, there's like a lot of truth, but also a little bit of lie in this video. And a lot of times people are led astray because there's a lot of misinformation on the internet. So you want to effectively communicate with clients. Documentation standards. Establish robust intake procedures for new deductions, VINs for the car loans, tip reports, overtime records, and things of that nature. Lastly, software updates. Ensure that the tax software reflects all of the OBBBA changes. Verify the calculations for phase outs and limits because a lot of times the sad reality is we rely on technology, but you know what? Technology fails. So we must make sure because in the event that we file a return that is inaccurate because of the tax software, unfortunately, it is absolutely not a defense. We still have to exhibit due diligence. And lastly, continuing education. Staying current on all the IRS guidance and regulations and monitor for any technical corrections or clarifications. So some key takeaways about things that changed. The standard deduction increased significantly. Again, it is indexed every year for inflation. The new deductions for workers and seniors, tips, overtime, senior additional deductions, but as we all know, these are temporary. The SALT cap relief for itemizers, again, I am very excited as a New York City resident for this one. We increased $30,000. So I can't wait to see what my Schedule A looks like this year. The child tax credit is also indexed upward. So instead of $2,000, it's now $2,200 per child. And again, the benefit with the credit is that it is a dollar for dollar reduction of one's tax liability. What hasn't changed, as we mentioned, progressive tax rates still in place. Itemizing versus standard deduction still in place. But again, a taxpayer cannot take both. They either take one or the other. So the great thing about Uncle Sam, sometimes people always try to make it seem like Uncle Sam is so greedy. They let you take the higher of the two. Only in certain limitations you would have to, claim a specific deduction. So that would be in a situation whereby someone is married filing separate. In such case, the individual that is married filing separate, both spouses need to claim the same deduction, even if the other deduction gives them a better benefit. But that's one of those nuanced situations. For the most part, most taxpayers, they claim the deduction that gives them the better benefit. Self-employment tax obligations still remain the same, 15.3 self-employment tax, but you do get a 1/2 deduction. And the fundamental compliance requirements, there needs to be accurate reporting, documentation, and timely filing still essential. So the core structure of the federal income tax remains the same. The OBBBA, they just modified specific provisions, but not the fundamental system. All right, so this brings us to our final point. So the tax law, it's not intentionable and it is learnable. So one key thing to keep in mind is that every tax provision, it reflects a policy choice. Understanding the structure of income, then deductions, then credits, then the tax liability. This makes even complex changes to the tax law manageable. So this one big, beautiful bill act, the OBBBA, it introduces significant changes, but the foundation remains consistent. And with proper planning, documentation, and professional guidance, taxpayers can navigate these changes effectively, right? So thank you so much for taking the time to watch this video. Should you have any questions, drop comments at the bottom. And should you have any questions, feel free to reach out. I'll leave my email in the description. Make sure that you reach out to your tax professional. And if you're ever in need of any assistance with your taxes, feel free to reach out.